think, act, and prosper. You are now tuned into the Money Level Show.
Hey everyone, welcome back to the Money Level Show, where we think, act, and prosper. This channel focuses on changing financial trajectories and building legacies. I'm your host, Daryl Thomas, and today you are in for a treat. You are receiving exclusive content from the New Orleans Investment Conference. I had the opportunity of interviewing multiple experts within their respective field in the finance and resource sector. So be sure to hit the subscribe button. Take a look at this statistic. Over 91% of people that have watched my channel over its lifetime have not subscribed. So hitting the subscribe button only takes a second, and it is free to you. And for me, when I put out this content, it costs me money and time. So I hope that you all understand that and hope that you consider hitting the subscribe button. So without further ado, let's get to the interview. I wanted to transition a little bit to some assets. I mean, we're here at the New Orleans Investment Conference, and so there's a lot of gold bugs here. And I'm bullish gold long term, but I'm use it as more of insurance for my money rather than like an investment, unless I'm getting into like some mining or royalty and streaming companies. And so what's kind of your take on gold at this time?
I like gold. I'm bullish on gold. When you look at central banks around the world, they don't necessarily want to have all their reserves in the U.S. Also, when you think of a sovereign reserve, there's kind of two parts of it. One hand, no country ever wants to ever draw down its reserves to zero, right? That'd be obviously a very bad, something terrible has happened if that has happened. So there's basically like their savings account, which they don't need to be as super liquid, but they want it to be secure. And then there's the part that they want to be able to buy and sell very quickly, right? They might want to defend their currency. They might want to pay for oil, for a long time, a lot of countries would hold all of that in dollars, or a big chunk of that in dollars. And I think now a lot of them are saying, okay, we can hold some dollars for quick, transaction we want to do, but for the bulk of it, maybe we want to put that in gold, or maybe we want to diversify that into a couple of different currencies. Maybe we want to make deals with Brazil to basically have a iron exposure for the next 10 years. Maybe we want to do kind of these private equity things. These are these less liquid things. And so I think we're seeing more diversification, and gold plays an important role there. Gold has often played the role of a insurance against kind of financial catastrophe. Going forward, even if we enter a Bitcoin world, a digital world, there's never a guarantee that you're always going to have access to the internet. Your private keys can be stored offline, but your ability to interact and receive, send payments and, kind of make verified transactions and things that could be limited. And so I think gold still serves a role for what if the internet gets disrupted? What if there's a cyber attack? What if the power goes out? What if this happens? What if kind of true mayhem happens, right? So I think that gold still has a role as a reserve asset, both at the sovereign level and the household level. It just doesn't really solve things at the transactional level. So I'm bullish long term. And I think that basically as the dollar over the long term enters more of a fiscal spiral type of scenario, where you have very large sovereign debts. If you have inflation and from those fiscal deficits, interest rates become a very mixed tool for fighting that, because interest rates blow out the deficit even more at these levels. It's not the Volcker era where you had 30% debt to GDP. And so the challenge is that I think a number of entities are going to seek alternative monies, and Bitcoin's still too small to really kind of serve at the sovereign reserve level, especially for large countries. Maybe it has to go through a couple more liquidity cycles, get tested a little bit more to see how it's doing. So, gold kind of still stands there as one of the strongest monetary networks in the world.
Yeah, that's really good take. So you mentioned in one of your recent newsletters, you have no strong conviction on the miners, and you're focused more on the royalty streaming. What benefits about the royalty streaming? I actually just interviewed Sandstorm Gold earlier today, and they're a royalty streaming company, and I was talking to them about the benefits of it. What are some of the benefits and hedges to risk do you see with the royalty and streamers?
So with miners, one of the biggest expenses is energy in its various forms, and so I'm bullish on gold, but I'm equally, or maybe perhaps more, but also bullish on energy, including oil, diesel, things like that, long term. And the problem there is that you can have a mine where your revenue is going up because the gold price is going up, but also your expenses are going up. All your diesel costs are going up. Even things like tires, they're made out of, all that equipment is going through tires on a regular basis. That's all made of hydrocarbons. And just all of that energy intensive work, the manufacturing of the machines, the diesel powered machines. And the problem is that if that's going up as quickly, your margins might still be squeezed. Gold royalty and streaming company gets almost all that upside, but doesn't really have to worry too much about that energy kind of cost, of course, but you're paying a higher valuation for that exposure. So I'd say that if someone is a lot more bullish on gold than oil, then the miners are probably quite interesting for them, because basically they're assuming that their analysis suggests that the revenue is probably going to go up more quickly than their costs. If someone is bullish on both gold and energy, they might then look into the streamers, because they say, well, I want to arbitrage the fact that both are going up and I want my expenses to be fixed. In addition, just streamers tend to be more diversified, a little bit lower risk. As a investment analyst in the macro sense, I don't really have time to kind of look through the geology of different companies. I'm not Rick Rule. I'm not going to go out there and identify these like really kind of complex situations. And so for me, I either stick to broad diversification, larger companies, streamers, things like that, to the extent that I want exposure other than just physical gold. Whereas someone who's more hands-on, they want to take all the risk and reward, can go into the more exploration type of areas, or small caps and things like that.
Yeah. So that was kind of what was coming in my head when I was talking with Sandstorm. It's like they do the homework for us. And so they go and assess jurisdictional risk, what projects are worth funding and things of that nature. So that's very helpful for a lot of people that don't have the time or the knowledge to go into the space and get into the weeds of everything. So crypto, we have Bitcoin and you have crypto, right? And so we're coming up on a halving cycle. There's been a lot more technology built. And so, but there's still this issue with liquidity still being flat. And I know that oftentimes many risk assets run with liquidity going up. And so what are you kind of thinking there?
I think so far, all of Bitcoin's major bull runs have occurred after halving and with positive liquidity conditions. We never really had one where just one was present. And that's often because liquidity cycles historically are about 3 years, and the halvings every 4 years. And so generally you get an overlap there. And so that's why the halving doesn't really, Bitcoin's bull run can happen right after halving. It can take a while after halving, because historically it's been both happen together is when Bitcoin has its big moment. We can kind of think of it as like two monies competing. So the smaller money Bitcoin gets harder every 4 years. Basically, the new supply goes down. The bigger money is always expanding, but at different rates, and for very brief periods of time, it can actually contract. And so when the bigger money is contracting, it's basically getting harder, for at least briefly. And so, Bitcoin's gonna have its most explosive moments when both it's hardening and the bigger money is softening. Liquidity is improving. That's going to give you the most Bitcoin price action. If they're opposing each other, which so far has not really happened yet, but if it should happen, you probably would expect a more intermediate outcome, where Bitcoin's, the supply-demand situations improve, but the liquidity of the other one is still also tight. And of course, the worst scenario is when Bitcoin's, not anywhere near halving and liquidity is worsening from the bigger network. Basically, the more of a mismatch there is, the more demand wants to flow out of the, expanding money into the scarce money. And whenever that takes a step back, demand dries up and there's really no catalyst. So I think that ideally you want to see both occur together. And I think eventually we'll see both occur together. Liquidity could happen right after the halving. It could take another year after the halving. It could take 6 months. I don't have a crystal ball on timing, but I do think that both are very important metrics. I think if someone's too focused on one or the other, they can miss out. If they say, I don't want to buy Bitcoin until liquidity is better, well, you might miss out on some of the cheaper exposures. On the other hand, if you only look at the halving and think you have to have a bull market after the halving, but liquidity from the dollar system is terrible in that time, you might get disappointed that it doesn't work on the time or the magnitude that you expect. So I think that both are helpful, and I don't really recommend trading Bitcoin too much, but I think it's more along the line of risk management, right? So if liquidity is low, if the halving's coming up, that's and the price is low, that's probably a good time to start accumulating a longer term position. And if euphoria is high, if the price is high, you just had a post-halving bull run, liquidity is like soaring and it's starting to roll over. It's not necessarily saying you might want to time the top, but you might want to just make sure how exposed are you to Bitcoin relative to your net worth. Would you feel comfortable with a 70% drop or more? And if not, maybe rebalance, right? Or maybe hedge, maybe whatever makes sense for your situation. So it's more about risk management and expectation setting than trying to trade it.
Yeah. And we had I forgot the number of cryptos we had out there. It was in the thousands, right? And I mean, we had a lot of Ponzi schemes. I mean, we just saw the whole Sam Bankman-Fried and his testimony and stuff. That was bad. But are more cryptos being created, or are they reducing, or some of them going out? I mean, I still see like the Shiba Inus and all the meme coins out there.
Cryptos rarely ever die. They eventually reach this like low level of almost dead liquidity. They're still there. They're still functioning, and more are created every day. The way I would describe it as, no matter how many pesos Argentina prints, it doesn't really affect the dollar, right? It's all these kind of long tail of stuff. The only thing that affects the dollar is like the euro, the yen, the yuan. What are the big ones doing compared to each other? So you can look at Bitcoin, you can look at Ethereum, you can look at stable coins, whatever Ethereum's competitor of the day is. Sometimes you have uprises trying to kind of compete with Ethereum. Those are the ones I think to generally focus on. And for me, Bitcoin and stablecoins are the most interesting aspect of the space. They're the ones that are actually money, and blockchain is really good at money. That's one of the main things it solves. It's still remains to be seen kind of what else can be solved by blockchain technology. Some of these things could be interesting little venture tech plays. But generally what you see is a big bubble in a given crypto, and then it just never really kind of reaches its highs again, especially denominated in Bitcoin. And so if you're playing with 20,000 other cryptos, you're pretty much playing with fire, because there's really only ever been like 3 of them that ever made like a higher high in Bitcoin denominated terms in the next cycle, right? So if you're gonna play that game, just know that the odds are not good.
Yeah, it's a speculation game pretty much. Tech stocks. I mean, the Magnificent Seven seem to be slowing down. And they've pretty much carried the S&P and such. And so, most tech stocks, when I'm looking at or growth stocks, PayPal, Twilio, and a few others, they're down significantly, versus like an NVIDIA and Microsoft and such. And so, it seems like, they need liquidity to really start to boost up a lot. And so, what's your take on the tech sector?
So I think we can put them in 2 camps. The ones that are killed are mostly the unprofitable ones. And the reason is that they have to constantly issue new equity in order to fund themselves. And if liquidity dries up, if the discount rate is much higher, if you can get paid 5.5% on T-bills rather than 0, maybe you're more valuation sensitive to these types of names. And if they were undercharging for their product to be unprofitable with maximum growth, always relying on issuing new equity, and that equity dries up, they have a problem, because now they're unprofitable. How do they finance themselves? Well, maybe they increase their prices, but then that slows down their growth. And then that makes equity investors realize, I don't want to invest there, right? So it's like a lot of that was malinvestment that kind of gets rationalized in that world where it's just not okay to be perpetually unprofitable and always issuing equity. Eventually your business has to identify its profitable point at some point. On the other hand, the profitable tech companies have been very resilient in this environment. Somewhat to my surprise, you'd think that with a 5.5%, discount rate, that some of these would be a little bit lower valuation. But what we are generally seeing is that the Apples, the Teslas of the world, they're slowing down while they have very high valuations, which of course puts them at risk. Other ones like Microsoft, Alphabet, they're still growing at pretty good clips, and they're profitable. And they're either able to hold shares flat, they're able to reduce their share count by buybacks if they want. And so they don't have the same problem that the unprofitable tech companies do. I think the main challenge that these Magnificent Seven are going to run into is not so much a crash or a major problem. It's more just like you could stagnate and go to choppy, and you could fall 20-30%, bounce 10-20%, fall 10%, and you could wake up 5 years later and realize the stock's gone nowhere. And maybe earnings kept going up, maybe revenue kept going up, but maybe the valuation fell from 40 earnings to 28 times earnings, right? And it just kind of you normalize over time. And I think that's the key risk. You have to kind of look at forward return expectations, and I think for most of them, it's not super attractive.
Yeah. Okay. And so transitioning to like emerging markets. I mean, the Chinese stocks. I mean, they've been getting decimated. I mean, JD, it's $25 or something. Like it came a long way down. I don't know much about China's economy and the macro environment there to really have a strong conviction on like, hey, I'm gonna go all in on these stocks because they're cheap. So what do you see there, and is there any opportunity there?
So they're currently running the opposite playbook of the United States. So the United States is maximum fiscal, maximum consumption, and kind of weak production. China is tight on the fiscal. They're not just giving people money. They're not running massive deficits. They're actually running pretty small deficits relative to their GDP. Their output is full on. Their exports are soaring. Their trade surplus is near its all-time highs. They've recently entered the car market. They've already passed Japan in terms of number of cars exported per quarter, which is just remarkable. But their consumption is flatlining. So they're going through a real estate bubble. They're going through just a normalization on their consumption side, partly intertwined with the fact that they're not doing fiscal. If the Chinese government came out and gave every Chinese person $3,000 equivalents to go spend, you probably would have a boom in the JDs of the world, for example, but that's not what's happening, unlike the United States. And so with China, their industrial side is doing great, their consumption side's not. Now, eventually I think we'll get another cycle of the consumption side, but that's the challenge there. It's really kind of dependent on what Xi Jinping wants to do. It's a very centralized economy, and so far they're really emphasizing the output side, not the consumption side. And so all the consumption side is suffering. They've also just done some kind of like top-down actions against Alibaba and JD, like a number of these companies, basically say like any excess profits you get are going to be threatened and kind of taken, redistributed to varying degrees. And so that makes investors say, well, maybe I don't want to hold this stock for the long term. I don't know what the changing political winds are going to happen to their bottom line, because they have all the risks of weak consumption, but should they get another really good bullish cycle, will the Chinese government just give them an extra $10 billion tax, for example, and take that from them? And so capital doesn't really want to go there too much right now. I think the Brazils of the world, I think there are other emerging markets that are more interesting on a risk-adjusted basis. That's kind of my take on it.
Okay. And then just want to wrap up with energy. So I've been looking more into the offshore drilling lately, as well as the tanker market. Do you have any specific thoughts on those two sectors?
So the energy segment, the whole energy complex, is one of the most areas that I'm bullish on with like a 5+ year view. Like I can't begin to tell you what's going to happen in 6 months, because that depends on recession or no recession. That depends on what China's going to do. Are they going to stimulate? Are they not going to stimulate? Because all of that affects the demand side. What we do know is that the supply side is very limited. So in terms of a new amount of capex that can come online quickly, the drillers are interesting because even to make a new drill ship, it's going to take years, and the shipyards are it's just that's kind of a locked in supply, and it's a very cheap area compared to replacement costs. So I think that as long as someone is careful with their investment decisions, energy is one of those areas that I'm not even going to try to trade too much. I just want to own it and see what happens over the next 5+ years, and then reevaluate. I monitor the space, but it's just not something that I want to trade. But it's just, I think we're due for another big price cycle, capex cycle, and just overall, that's what we're short on now. There's other areas that we're abundant in, and energy is the one where the world's pretty tight on at the moment.
Yeah, I've been looking outside of the U.S. Rick's been encouraging us to buy like the bigs, the Exxons, the Chevrons and such. I'm like, Rick, man, I can get Echo Patrol and Petrobras like way cheaper with a way higher dividend. And so I'm trying to like, balance that out. But in terms of like, emerging markets, like, I mean, you have some really solid companies that average American investors aren't necessarily investing in. And so I'm kind of learning these companies on the Toronto Stock Exchange or in other nations, that are attractive investments. And so it's a lot out there.
Yeah, of course. The challenge is the jurisdiction. So basically, I think that's manageable with position sizes. I mean, an example I ran into is, Lukoil has historically been one of the best performing oil majors in the world. They didn't do destructive acquisitions when many other companies did over the cycles. They managed themselves very well. But if you're an American holding Lukoil, you got wrecked through no fault of Lukoil, right?
You're like looking at my soul right now. I experienced it.
Yeah, me too. I was bullish on the company, and you just get blindsided by things that are just not in that company's control, and the company's still operating. It's just that your foreign claims for it are kind of highly questionable, to say the least, and that can happen in multiple of these jurisdictions. So I think that's manageable through position size. By not having overly aggressive positions in some of these more troubling jurisdictions, because there's a chance that a Brazilian oil company goes to zero, virtually zero chance that ExxonMobil is going to go to zero. But in a positive scenario, your upside from the Brazilian one is probably going to be much larger, right? So you can balance that by, diversifying, having decent position sizes. For me, I'm just so bullish in the energy complex. Last thing I want to do is be overly concentrated and make bad decisions and miss the bigger move. So for me, I want to capture the bigger move and take pockets of risk where I can.
Yeah, that makes total sense. I mean, because obviously in the U.S. there's due process and versus other nations, like the government just can come and just make whatever decision and affect the company. So that makes total sense. Well, Lyn, I appreciate you for coming on. I know you just got off the plane and you got to get some food and all of that. And so where can people find more about you? Also, you all be sure to Broken Money. It's 500 pages, y'all. I think it's 500 pages?
Yes.
All right, it's going to take me about 2 years to get through this.
But it's very accessible.
It's good. Yeah. It's good.
So check out Broken Money. Check out lynalden.com for research.
How many pages do you read? Like, how many books do you read? You read a lot, do a lot of research.
I read a decent number of books, but for the most part, I look at research more than books. I crunch numbers. I look at articles. I look at documents more than I look at full books, or I read parts of books. I definitely absorb a lot of information, but it's not always in book form.
Yeah.
And that's why I didn't write a book just for the sake of writing a book, because I don't want to read someone else's book for the sake of being a book. Like, if you can make it an article, make it an article. That's what I try to do. The reason I wrote the book and the reason it's kind of well received is because I only wrote the book after I realized this has to be a book. This is not going to be a series of articles. I can't put the same information in that. It has to be kind of read in a kind of linear way to actually have the reader kind of go away with it. So I've been humbled by the reception from it.
Yeah, I got Neil Howe's book, I got Nomi Prins' book, and I got Lyn Alden's book. It's probably going to take me about 2 years, y'all, to get through these books. But no, I'm just finishing up my master's degree, so I did a lot of reading for that. But I'm going to be done next month, so got to be happy for that. And so then hopefully we'll be able to spend more time in research. And so thank you for coming on, Lyn. Y'all be sure to go check out Broken Money as well as lynalden.com. Very accessible research. I mean, you even have a lot of stuff for people that are just beginning, like what's a credit score? How do you build it? There's so many tools there for you all to succeed and thrive. And so thank you, Lyn, for coming on.
Thank you.